Good evening and welcome back to my YouTube channel. Today I'll do a question on group cash flow. And if you are on my channel for the first time, please subscribe and please like this video so that we can get more views. Without a much ado, let me go to the question straight away. And I'll read the question. The following are the group statement of comprehensive income and the group statement of financial position of Maneno Group of Companies for the financial years ended 31st October 2021 and 31st October 2017. Yeah, we have Maneno Group statement of comprehensive income for the year ended 31st October 2017. Yeah, from revenue all the way to profit after tax. Then we also have Maneno Group statement of financial position as at 31st October 2017 and 2016. Yeah, then we have additional information. Number one, during the year ended 31st October 2017, depreciation of shillings 240 million was charged in relation to property, plant, and equipment. Number two, an item of property with a carrying value of shillings 885 million was disposed of during the year ended 31st October 2017 for shillings 750 million in cash. The loss on disposal is part of cost of sales. Number three, on 1st August 2017, the group disposed of an 80% owned subsidiary for shillings 1170 million in cash. The subsidiary has the following net assets as at the date of disposal. So we have property, plant and equipment, inventory, trade receivables, cash and bank balances, trade payable, current tax, bank loans. The subsidiary has been acquired on 1st November 2012 for a cash payment of shillings 660 million when its net assets had a fair value of shillings 675 million and the non-controlling interest had a fair value of shillings 150 million. Yeah, so we'll use this information to calculate the goodwill on acquisition of the subsidiary. Number four, additional property, plant and equipment was acquired by way of lease amounting to shillings 900 million during the year ended 31st October 2017. Number five, dividends paid by the holding company during the year ended 31st October 2017 amounted to shillings 120 million. And number six, land was revalued upwards by the holding company by shillings 60 million during the year ended 31st October 2017. Required the group statement of cash flows in accordance with IAS 7 statement of cash flows for the year ended 31st October 2017. Yeah, so you have 20 marks. Yeah, and this is an area that they will test on BDA. So I'll attach this question on the description on my YouTube so that you can follow even as you look at the question. So I'll start. So stay in Maneno Group. Statement of cash flow. For the year ended 31st October 2017. So I'll create the bottom border here. Then I'll merge all this and center. I'll also merge that and center. I'll also merge all the way and center. Yeah, so the shillings were in, let me see, in millions. So I'll copy that. Yeah, then the format is just to start with operating activities. So I'll bold that, then create the bottom border. And we start with the profit before tax. So I'll just go to the statement of other comprehensive income, statement of comprehensive income for the year ended 31st. Yeah, to check the profit before tax, because this is what we start with. Yeah, and you pick the amount. Yeah, so the amount is 699. Then we do the adjustment. So we'll say adjust for yeah, you do the adjustment. Yeah, so the first adjustment will always be for depreciation and the two cousins, depreciation, amortization, and impairment. So I'll start with depreciation. So what was the depreciation for the year? For depreciation, we add it back. So I'll check. There was additional information. Number one, they're saying during the year ended 31st October 2017, depreciation of shillings 240 million was charged in relation to property, plant, and equipment. Yeah, so the depreciation was 240 million. Yeah, so I'll go to the next adjustment. I'll check whether there was impairment. Yeah, so by checking impairment, because we're not given on the additional information, I'll go straight away to the statement of financial position other than current assets, and I'll check the goodwill. Yeah, you check the goodwill. So there was goodwill. So it means that there's an item of impairment. So I'll first calculate the goodwill on acquisition of the subsidiary. So you'll allow me to do my workings here. So you'll have goodwill for the subsidiary. Yeah, so the goodwill, there was information which was provided here. Additional information number 3, they say the subsidiary has been acquired on 1st November 2012 for a cash payment of shillings 660 million. Yeah, so that's the purchase consideration. So the purchase consideration was 660 million. Then when its net asset had a fair value of shillings 675 million, yeah, so those are the net assets acquired, and the non-controlling interest had a fair value of shillings 150 million. Now that we are given the non-controlling interest, then we'll use the full goodwill method. Yeah, so the fair value, we'll add the fair value of NCI, which is the non-controlling interest. So we'll add it to the purchase consideration. And it was how much? It was 150. Yeah, it was 150 million. So that, let me sum these two. Enter, so I'll have 810. Then you less the net assets acquired. That's the net assets. I'll put a negative sign there. We are told that the net assets had a fair value of 675. So I'll subtract that 675. Yeah, this is the full goodwill method. Yeah, so that I get the goodwill on acquisition of that subsidiary. So I'll just sum these two, 8 and 75, 675. Yeah, and the goodwill on acquisition of subsidiary was 135. So I'll create the goodwill account so that to be able to know whether there was impairment or not. So I'll have a goodwill account here. So you'll have the balance brought down. So I'll go to the statement of financial position and check the balance brought down under goodwill. So you come here, so the balance brought down was 390, yeah, for the previous year, 2016. So it will be 390, but there's this subsidiary that was disposed. So we disposed the subsidiary with its goodwill. Yeah, so unless goodwill disposed, so you less goodwill disposed. Yeah, so how much was the goodwill? It was 135. We have just calculated it here. It is 135. Yeah, because we disposed that subsidiary. So it goes with the goodwill. So that we sum this to we'll get 255. Yeah, then we compare what is the balance carried down under the goodwill account. Yeah. So let us see the balance carried down. The balance carried down is the balance for this year, the year on focus, which is 2017. So we have 255 here. Yeah, so you can see it was 255 and the balance carried on is also 255. So the difference could have been the impairment loss. Yeah, so the difference is the impairment loss. So let us see. Sorry for that. Yeah, so the impairment loss will be this minus this. Yeah, so there was no impairment loss. So the impairment loss was 0. The impairment loss was 0. So just come and say equals to, and you pick that. Then you pick the impairment, which is 0. Yeah, so the other item here we could have adjusted was the amortization. So you go back to the statement of profit or the statement of financial position, sorry. So you check under non-current assets. Was there intangible asset? No, there's no intangible assets. Yeah, there's no intangible assets. So we are done with that adjustment. So the next adjustment we'll check is investment in associate. Yeah, so the investment in associate, there was that we won't use, we won't adjust it by amortization. We only adjust the intangible assets. So the next item which you have to adjust under adjustment is the loss or gain on disposal of PPE. Yeah, was there a loss or gain on disposal of PPE? There was additional information number 2. They're saying an item of property with a carrying value of shillings 885 million was disposed of during the year ended 31st October 2017 for shillings 750 million in cash. The loss on disposal is part of cost of sales. Yeah, so there was loss on disposal of PPE. So that's an adjustment. Yeah, so if it is a loss, you add it back. If it was a gain on disposal of PPE, then you subtract. So the loss will be, the carrying value was 885. That's the net book value. And it was disposed for 750. So you take 885, you subtract 750 to get the loss, which is 135. Yeah, so after doing that adjustment, now you go back to the statement of profit or loss. And this is how you do the adjustment. These are the only the 4 adjustments what we are supposed to cram and have in mind. The other adjustment will be guided by the question. So just come to where the profit before tax is, then you move upwards and you do adjustment, all other items except distribution cost and administration expenses and the gross profit. Yeah, you don't adjust beyond the gross profit. So I'll start before profit before tax. Upwards, we have finance costs. So that's the first adjustment I'm going to do. Yeah, so I'll start with the finance cost above the profit before tax. Yeah, so you check this adjustment above. If it was deducted, then you add it back. If it was added, then you deduct it. Yeah, so finance cost, I can see it was deducted. Yeah, it was an expense. So I'll add it back. So I'll say equal sign, then I pick the value. Yeah, then I'll pick that value. Yeah, so it's positive. So the next item will be administration expenses, which we don't adjust. Distribution cost, we don't adjust. Then the next item up here is share of profit after tax in associate. Yeah, so you can see all these were added back to gross profit. So you take this. Sorry, let me put an equal sign here. Sorry for that. Yeah, so the share of profit after tax in associate. Yeah, so it will be equals to negative because it was added. It was a positive figure. So you subtract it when you are doing adjustments. Yeah, you subtract it. So I'll deduct it. Then another adjustment is gain on sale of subsidiary. Yeah, so the gain on sale of subsidiary will also deduct it. To get that. So is there any adjustment above the profit before tax? There's no any other adjustment because here now we have the gross profit. Yeah, so those are the only adjustment you have to do to the profit before tax so that we can get the sum. Yeah, so this is what we'll call the cash flow. Cash flow from operating activities before changes in working capital. Before changes in working capital. Yeah, before changes in working capital. So allow me to increase the size of this cell, the size of this column. Yeah. Okay, so we'll have the sum this. Yeah, so we'll have 1260. So let me create the top border there. Yeah, then the next adjustment will be the working capital. So I'll bold it and create the bottom border. Yeah, so the working capital, there are always three items. We have inventory, trade receivables, and trade payable. So let's start with the inventory. Yeah, so this is always what you check. Huh? Whenever there's an increase, you check on the current assets under inventory. If there's an increase, like in this case, there's an increase, then that's a cash outflow. It means that we have been buying inventory but not selling. Yeah, so we spend money instead of getting money. The same applies to trade receivables. Whenever there's an increase, then it means that we are not making money. We are not receiving money from where we continue to sell in credit, but we are not receiving more money. The opposite is true. If there's a decrease in inventory, then it means that we have been selling inventory and we are receiving cash. Yeah, so that's a cash inflow. However, the same applies to trade receivables. If there's a reduction in trade receivable, then it means that we have been receiving money. Yeah, we have been receiving money. So for current assets adjustment, an increase is a cash outflow. An increase is a decrease, sorry, an increase is a cash outflow. A decrease is a cash inflow. The opposite applies to now to liability, which in focus is the trade payable. In trade payables, whenever there's an increase, then it means that we continue to get goods credit, but we're not spending money to pay. So an increase in trade payable is a cash inflow. It's an income. While a decrease in trade payable is a cash outflow, meaning that we're spending money to pay for goods. Yeah, that's the analysis. Yeah, so I'll start with inventory, so I'll be able to explain it well. So I'll open an inventory account. Reason being, there was a subsidiary which was disposed. Yeah, so I'll have to open an inventory account. Yeah, so we'll start with the balance brought down on inventory. Yeah, we had 3090 at the beginning. Then you less for the subsidiary which was disposed. So you less, let us see how much was disposed, how much inventory. You come to this additional information number 3, where they say on 1st August 2017, the group disposed of an 80% owned subsidiary for shillings 1170 million in cash. The subsidiary had the following net assets at the date of disposal. So we have property, plant, and equipment, but now we have inventory. Yeah. So there was an inventory of 90, which was disposed. Yeah. So this was what I was looking for. Yeah. So initially we had 3090, but we disposed 90. So what is our balance? So I'll sum these two. So we have a balance of 3,000. So I'll compare with the balance carried down, whether there was an increase or a decrease. Yeah, so the balance carried down was 3,900. Yeah, so we move from 3,000 to 3,900. That's an increase in inventory. And wherever there's an increase in inventory, that's a cash outflow. So that's an expense. So just say here, the difference is 3,000 minus 3,900. Yeah, because there was an increase in inventory. So that's a cash outflow. Yeah, so I'll just come and pick it. So it's an increase in inventory. So you pick, just select that. So the next item, the trade receivable. Sorry, trade receivables, this one. Yeah, we'll do the same. We'll open an account for trade receivable. And I'll do it here. Yeah, so we start with the balance brought down. The balance brought down, just go to the statement of financial position. You have 3120, but there was disposal, yeah? Yeah, so I'll just use these items here. So less subsidiary. How much was disposed under trade receivables? Let me see from the additional information. So we disposed 135. So I'll select that 135 so that I check the balance. So the balance, I'll just drag that and then it will give me 2985. So I'll check the balance carried down. Yeah, the balance carried down was 31.20. So there was an increase from 29.85 to 31.20. And whenever there's an increase in trade receivable, that's a cash outflow. Yeah, so we'll get the difference. Yeah, so I'll just drag this to get that difference. Yeah, so the difference is 135. So just come here and pick 135. Yeah, so the next adjustment will be the trade payable under working capital. Trade payable will do the same. Yeah, we'll have, let me increase the size of that column. So we'll have trade payable here account. Yeah, we'll prepare the same account. Yeah, so we'll start with the balance brought down. The balance brought down was 1785. Then we had less subsidiary. Yeah, this less subsidiary. So how much was disposed? Because they disposed a subsidiary. So I'll check the additional information. Trade payable, they disposed 540. It's already negative. So let me just remove that negative sign. Let's select it the way it is. So they disposed 540. So how much were we supposed to have? So I just drag this here. It will give me 1245. And now the balance carried down. The balance carried down. Trade payable, sorry. 2955. So we had an increase from 1245 to 2955. And I said that whenever there's an increase in trade payable, then that's a cash inflow. Yeah, whenever there's an increase, yeah, that's a cash inflow. So we'll get the difference between this and that. That's the cash inflow of 1710. So just come here and say equals to, then you pick that. Then pick that. Yeah. So from that point, now we can be able to get the cash flow. Cash flow from operating activities. From operating activities before tax. Before tax. So we'll sum all this. So we'll sum from this point up to here. Yeah, from cash flow from operating activities before working capital changes. So we'll have 1935. Create a top border. Then we look at the tax. So this is the tax paid. So we'll have to open a tax account. This adjustment, we must open a tax account. So I'll do my workings here. Let me increase the size of this. So I'll do my workings here. So I'll do tax account. Yeah. So tax account, we'll start with the balance brought down. Yeah, and this balance brought down, we'll get it on the statement of financial position. So you always check, as a student, you check the statement of financial position, you check the non-current and current liabilities. So on the non-current liabilities, we have deferred tax. We have deferred tax, so we'll take that and we add to the current tax under non-current liability. So we'll add to that. Yeah, we'll add to that. So we'll have 978. Then there was tax for the year. There was tax for the year. There was tax charged for the year. So we'll add it back to the balance brought down. And I know it's negative, so I'll introduce a negative sign so that it changes to positive. So that you'll get on the statement of comprehensive income. Income tax, you can see this income tax expense. Yeah, so you pick that 144. Then there was a subsidiary that was disposed. Yeah, so we check whether there was tax it was disposed with. So less subsidiary. So this will be equals to negative because it's reducing the total amount. So current tax, it was 15. I can see it was already negative. Let me remove the negative sign. Yeah, so it was 15. You can see the current tax because it was disposed. Yeah, it has to reduce the amount of the tax account. Yeah, so that we can get this. So I'll sum all this. That's the only adjustment under tax. So we'll get 1107. Then this will compare with the balance carried down. So how much do we have as the balance carried down on the statement of financial position? Yeah, so the balance carried down, you come here, you still do the same. You check the non-current liabilities and you pick that. You add to current liability, which is the current tax. You add to that. Yeah, so we move from 1107. But now we have a carried down of 1104. So how much did we pay? We pay the difference between these two. So that's tax paid. So the tax paid will be the difference between these two. Because I want it to be negative, I'll take 1104 and subtract 1107. So tax paid was 3 million. Yeah, so I'll just come here and say tax paid. Will be equals to, then I'll select that. Yeah, so that I can get the cash flow from operating activities. Cash flow from operating activities. Yeah, so it will be the sum between these two. So I'll sum. Yeah, so this will be my A. Yeah, so this will be my A. Yeah, so we'll have this as my A. So allow me to include it here. Sorry. Let me see what I can do. Let me insert. Yeah, that's okay. Yeah, so that's okay. So I can say, yeah, this is A. That will be my A. So I'll bold this. Then create a top border there. Yeah, that's okay. So we are done with the operating activities. That's how you do the operating activities on cash flow. So the next will be investing activities. Investing activities. And investing activities, you always check at the non-current assets. Yeah, you always check on the non-current assets. Bottom border. So you always start with the cash paid to acquire cash received, sorry. Cash received on disposal of PPE. Cash received on disposal of PPE, of plant property and equipment. Yeah, so there was additional information. There was additional information number 2. They're saying an item of property with a carrying value of shillings 885 million was disposed of during the year ended 31st October 2017 for shilling 750 million in cash. Yeah. So the 750 million, that's the cash received on disposal of PPE. Yeah. So that's the cash received on disposal of PPE. Yeah. So the next item, with the cash paid to acquire PPE, cash paid to acquire PPE. Yeah, so this will require us to prepare. This will require us to prepare a PPE account. So I'll do the PPE account here. And PPE, property, plant and equipment account. Yeah, the same way. Sorry, let me do this here. Property, plant and equipment account. Yeah, so we start with the balance brought down. So you go to the statement of financial position under non-current assets. The what I added as separated them, but it's okay. So the balance brought down, you can see this 2016. So the balance brought down is 13,500. So I'll pick it. Then I'll check the adjustment. The first adjustment always is the depreciation. Yeah, there was a depreciation. And how much was depreciation? Depreciation will reduce the amount, the net book value of property, plant, and equipment. So let me check the depreciation for the year. The depreciation, we are told under additional information number 1, that during the year ended 31st October 2017, depreciation of shillings 240 million was charged in relation to property, plant, and equipment here. So we have a depreciation of 240 million. Yeah, the next adjustment, which will reduce the property, plant, and equipment, is the disposal. Yeah, we disposed an item. So you say equals, then you put a negative. Yeah, and additional information number 2, they say an item of property with a carrying value of shillings 885 million was disposed of. Yeah, so items of PPE are disposed at carrying value, also known as the net book value. Yeah, you disposed items at net book value, not at cost. You disposed item at carrying value, stroke net book value. So they disposed an item with a carrying value of 885 million. So that's what we subtract. So 885 million. Then there was a subsidiary. Yeah, so there was a subsidiary that was disposed. We want to see how much PPE was disposed. So just say less subsidiary. Yeah, so took a negative. Yeah, because what was disposed goes with the subsidiary. So property, plant, and equipment, we disposed 2025. So I'll pick that 2025. Yeah, then the other adjustment will be, there was an item of lease. So you add back the lease. There was a lease. So let me see. And additional information number 4, they're saying additional property, plant, and equipment was acquired by way of lease amounting to shillings 900 million during the year ended 31st October 2017. Yeah, so we add it back, the 900 million. Yeah. Then the other item, there was a revaluation. Number 6, additional information, they're saying land was revalued upwards by the holding company by shilling 60 million during the year ended 31st October 2017. So there was a revaluation. So revaluation will increase the value of the PPE. So there was a revaluation of 60 million. Yeah, and those were the only adjustments. Yeah, so I'll sum this and compare with the closing balance, the balance carried down. Yeah, so we'll have 11,310. So let me see the balance carried down was how much. Yeah, the balance carried down for 2017 was 18. So you can see we were supposed to have 11,310, but we are at 18,000. So it means that there's some property which was acquired. Yeah, so this is the acquired PPE. Yeah, the difference. The difference is the acquired PPE. So the difference will be, I'll take that and subtract 18,000 because it was cash paid to acquire PPE. So it's a payment. That's why I've changed it to negative. So I just subtracted this minus this. Yeah, so the cash paid to acquire PPE will be 66.90, and you just select it that way. So after PPE, we go to the next item. I told you that under investing, you check all the items under non-current assets. So the next item is goodwill, which already we have worked with when we were calculating the impairment. Yeah, so we are done with goodwill. So the next item is investment in associate. So investment in associate, we'll open an investment in associate account to determine the dividend that we received from associate. So I'll prepare. Now I'll prepare an investment in associate account. Yeah, this account will help us to determine the dividend that the parent received from the associate. Yeah, so investment in associate account. Yeah, so we start with the balance brought down as per the statement of financial position. So the balance brought down. The balance brought down was 420. Yeah, was there any investment income for the year? So let me see for the year. You go to the statement of comprehensive income. So here we have, you can see there was a share of profit after tax in associate. So this share will add back to the balance brought down. Yeah, so that's for the year. Sorry, I didn't put the equal sign so that I can select the value. So this will be equals to the 144, the share of associate, profit after tax of associate. Yeah, so this will be for the year. So we'll pick the 144. Then now the total will be, I'll sum these two. Then I'll compare with the closing balance, whether there was any dividend that was received. Yeah, so my closing balance will be the balance carried down and statement of financial position. And that will be 510. So you see, we were supposed to have 564, but we now have a balance of 510. So it means that there was dividend which was received. Yeah. So dividend from associate. Yeah, that's the dividend from associate. That's the balancing figure. Yeah, we were supposed to be at 564, but now we have 510. So it means that we reduced this 564 by paying dividends. So there was a dividend that we received from an associate. So we'll take 564 minus 510. So the dividend paid is 54. So I'll just come here and copy dividend from associate. Then I'll pick that 54. Yeah, dividend from associate. Yeah, so that's the dividend that we paid. So I'll check if I've exhausted all the items under non-current assets, because we work with what is under the non-current assets. Yeah, so I've exhausted everything. Yeah, so I'll go to another adjustment. There's adjustment. This is a group cash flow. So the other adjustment will be, if there was investment income, then we will include it here, but it was not there in this question. Yeah, so you include it here. It was not there. So the next adjustment will be the net cash received on disposal of subsidiary. Yeah, so the net cash received on disposal of subsidiary. Yeah, so here we'll go to additional information and check how much did you receive. So you just come and say equals to. Then you go to additional information. Yeah, number 3, they're saying on 1st August 2017, the group disposed of an 80% owned subsidiary for shillings 1170 million in cash. Yeah, so they receive 1170 million. The subsidiary has the following net assets as the date of disposal. So let us see if there was cash which was disposed with the subsidiary. So there was a disposal of cash and bank balances of 105. So the net cash, you will take 1170 minus 105 to get the net cash received on disposal of subsidiary. Because yes, you received 1170, but you disposed another 105. So the net cash will be 1170 minus 105. So just come and say 1170 minus this 105, because this was disposed, so it reduces that. So we'll have 1065 as the net cash received on sale of subsidiary or disposal of subsidiary. Yeah, so there's no any other adjustment. So I'll sum this. And this will be my B. That will be my B. And this is now, the total of this is the cash flow from investing activities. Cash flow from investing activities. And I'll bold this. Sorry. I'll bold that. Then I'll create the top border here. Yeah, so I didn't bold this. Let me bold it. Investing. Yeah, so the last part is the financing activities. Financing activities. You bold it, then you create the bottom border. Yeah, so financing activities, always you look at all the equity and liabilities, except under the liabilities, except the trade payable, which is a working capital, and the bank overdraft, which is a cash and cash equivalent. So I'll start with I'll go direct to the statement of financial position and check on the equity. So start with the ordinary share capital. Yeah, and this is the reasoning. On these financing activities, we'll check whether there was cash received on issue of new shares. Whenever shares increase over time, then it means that there was an issue. And issues happen at par and at premium. Yeah, so we'll check ordinary share capital initially at the beginning of the year. it was 4,500, but it decreased to 6,000. So there was an issue of new shares. So that's a cash inflow. So we'll take 6,000. So I'll just select 6,000 minus 4,500. Yeah, because that's the adjustment. Yeah. Yeah, so you'll get an inflow of 1,500 because there was an increase of shares. So shares were issued and that's an income. So the next item is the share premium. Yeah, because shares were issued, there was a premium. They were issued at a premium. So we'll have a share premium. Yeah, so the share premium, we'll do the same. We'll do the same. We'll take 900 minus 0. And we'll get 900. Yeah, so we go to the next item. Under equity, as we do the adjustments, we have the revaluation reserve. Revaluation reserve is not a cash inflow, so we will avoid it. Then we go to the retained profit, and under retained profit, allow me to adjust this. Under retained profit, we have shareholders' funds attributable to. Let me remove this first. Yeah, you can see this question. We had retained profit, but here now, retained profit is always used to calculate the dividend paid. And because this is a group cash flow, then we'll have dividend paid to parent and dividend paid to non-controlling interest. Yeah. So this is what happens. There's shareholder funds attributable to parent, which is that. And we'll also use shareholder funds attributable to NCI. This is what we'll use as we calculate the NCI profit. And so it's dividend. I've said that retained profit is used to calculate dividend. So let me write it here. So we'll have dividend. So we'll have dividend paid by dividends paid to holding company, which is the parent. Yeah, that was provided. That was provided. So there's no need of calculating it. And additional information number 5. They have said dividends paid by the holding company during the year ended 31st October 2017 amounted to shillings 120 million. So it was a payment of 120 million. So we paid, so it will be negative 120. So the other dividend will be paid to NCI. Paid to non-controlling interest. And this will have to open account to do an account of that. Yeah, so you will allow me to do it here. Allow me to do it here. Yeah, so we'll have the NCI account. Yeah, NCI account. Yeah, but remember this on retained profit. Yeah. So I'll start with the balance brought down. So the balance brought down. Let me go back. Let me move. So the balance brought down will be this 525 because that's the shareholder funds attributable to NCI. Then we look at the profit or loss for the year for NCI. Profit stock loss for the year Yeah, how much was attributable to NCI on the comprehensive income? We add it back to the original, to the balance brought down. So you'll go to the statement of finance, the statement of profit or loss, and you check. Sorry, yeah. So there was attributable to parent. Yeah, you can see the total comprehensive income for the year attributable to parent and attributable to non-controlling interest. So we'll add that 75 back. Then there was a subsidiary. Yeah, there was a subsidiary that was disposed. Huh? So we'll say less subsidiary. Yeah, the subsidiary, let's go to additional information. We'll go to additional information. We are told that on 1st August 2017, the group disposed of an 80% owned subsidiary for 1170 million in cash. The subsidiary has the following net assets at the date of disposal. So it was 80% owned. So it means that NCI remained with 20%. Yeah. So the net assets were 1200. The subsidiary has been acquired on 1st October for a cash payment of 660 million. When its net asset had a fair value of shilling 675 million. So this is what we do to less the subsidiary, and the non-controlling interest at a fair value of shillings 150 million. So we'll take 150 million, which is the fair value of non-controlling interest. Then we add to, there was a 20%. Sorry, let me, yeah, so we'll take 150%. It's okay. So 150 million, which is the fair value of the non-controlling interest, will add to the 20% of the 20% of the total net assets, which was of the subsidiary, which was disposed, which is 1200, minus the fair value of the net assets when this subsidiary was acquired. When this subsidiary was acquired, which is 675, according to that additional information. Let me see. Yeah. So you take the 150, which is the fair value of non-controlling interest, you add to the proportion of the NCI. So if the fair value of the net assets at when it was disposed was 1200, you subtract the fair value when it was acquired, which is 675, so that you get to know the current value. So you take 150 plus 20%, minus times 1,200 minus 675. Sorry, I think there's a mix-up. Let me see. Let me close the bracket for this. Let me put that bracket. Still not yet. So take 150. Let me see. Still not. I don't know why it's not giving me the values, because that's a big number. So this is what we do. You take 20% first. Let me take 20%. You multiply by the net assets, the fair value of the net assets at the point when it was disposed, and we have been given here as 1200. Sorry. We've been given the net assets as 1200. Then that you subtract the fair value. You can see the fair value of the net assets at acquisition was 675. So you subtract 675. Then you add to the fair value of the non-controlling interest, which was 150. Let me see if it will work that way. 150, yeah. So you enter, yeah. So when you enter, yeah, it's okay now. When you enter, you'll have 255, and this 255 should be negative. Yeah, because we are subtracting. So I'll create brackets here. Then I put a negative sign here. Yeah, so that we get 255. Yeah, so that's the only adjustment to do under NCI. So this information is helping us to calculate the dividend paid to NCI. So let me sum this and see what was supposed to be our balance. So I'll sum this. We'll have 345. Then the balance carried down. Let me check what we have carried down. Yeah, you get that on the statement of financial position. Yeah, shareholder funds attributable to NCI. So we'll compare with 225. So we were supposed to be at 345, but we have 225. So the difference is the dividend which has been paid. Yeah, so the dividend. So that's the difference. So it was a payment. So let me subtract. So I'll pick that minus 345. And I'll get 120 also. Get 120 also for that. Yeah. So I'll just go to the statement and I'll just copy the value the way it is, which is 120. So we continue with the adjustment. So I'll go back to the statement of financial position. Yeah, so I'm done with this. So I'll go to non-current liabilities. So I'll go to bank loans. Sorry. Yeah, so the bank loans, yeah, there's this gap here, but it should not worry you because I inserted a column here. So you have bank loans. Bank loans will help you. You will be able to determine the bank loans by checking. You check at the beginning, it was 3,000, but it has increased to 4,200. That tells you that there was an increase in bank loan. So it means that you acquired more money. But there are adjustments to this bank loan account. So I'll do the adjustments so that you see how we come up with the value. So say bank loan account. Let me put it there. Bank loan account. Yeah, so you'll have the balance brought down. So you go there and pick the balance brought down. So the balance brought down was 3,000, but there was a subsidiary that was disposed. So you less, that's if it goes with, yeah, so you less, huh? So there was a bank loan of how much? Let me not put the negative sign because the bank loan might be having, yeah, so there was a bank loan of 600. Yeah, so you subtract this. Yeah, it reduces the amount now because this was disposed, so that we get the sum of this. Yeah, so we'll have 2,400. So we'll compare now 2,400 and the balance carried down. Yeah, so the balance carried down. Yeah, the balance carried down was 4,200. So you can see we have moved from 2,400 to 4,200. So it means that there was acquisition. Yeah, so there was loan acquisition. Yeah, the balancing figure is the loan acquisition. And when you acquire loan, then that's a cash inflow because you are receiving money. Yeah, so there was a cash inflow of how much? The difference between 4,200 and 2,400. So there was a cash inflow of 1,800. So that's loan acquisition. So you go to loan acquisition. So loan acquisition will be equals to, you just pick the value there, that account which we had adjusted. It was 1800. So you continue, you just move again, you go back to the trial balance. You go to not trial balance, but statement of financial position. So there is the next item here is the obligation under finance lease. Yeah, and you can see there's obligation under finance lease, under non-current liabilities, and also under current liabilities. So we'll combine them the way you combine the two tax, that is deferred and current tax. So we'll check whether there was a lease repayment or they were acquired more lease. Yeah, so that's the adjustment that we are going to do next. Yeah, so you will do another adjustment. Just a minute. Yeah, so I'll do the lease obligation. Yeah. Lease obligation. So we'll have the balance brought down and we'll combine the two. Yeah, we'll combine the two. So the balance brought down, I'll go back to the statement of financial position and check obligation under finance. Yeah, it's this one. So I'll combine them plus the one under this one. Yeah. So that will be my balance brought down. Then we acquired more PPE through lease. Yeah, so we acquired. So it will increase that number. We acquired PPE and additional information number. Let me go back. Number 4, additional property, plant and equipment was acquired by way of lease amounted to shillings 900 million. Yeah, so those under lease, that's a lease obligation. Yeah, so it will increase the original, the balance brought down. So we'll have 900 here. So that I sum these two and compare with the closing balance, which is the balance carried down. So we'll have 1065. Then let me now compare with whether there was a lease, whether we pay or we acquired more. So I'll say carried down. Sorry. So the balance carried down will be, I'll sum those two again. So we have this one under non-current, and I'll add to the one under current. Yeah, we combine them once again. So the difference is what will guide us. So we are supposed to have 1065, but we now have an obligation of 675. So it means that we made a payment. Yeah. So that payment is what we call lease payment. We made some payment. We were supposed to be at 1065, but we are now at 675. So the payment should be negative. So I'll just take that and subtract other one. So there was a lease payment of 390 million. Yeah, so just come here and adjust it. So come and say lease payment. Then you just pick the value here the way it is, the 390. Yeah, we continue. Continue with the adjustment. I told you that it's equity and liability. Yeah, you adjust everything. Yeah, so we are at obligation under finance lease, so that's okay. Then we have deferred tax. Already we have worked on that. Trade payable already. Accrued interest. Yeah, so we have the next item as accrued interest. So we'll open an interest account. Yeah, we'll open an interest account. So I'll do it here. Yeah, so we start with the balance brought down. So the balance brought down is this, it's 27. Then there's interest for the year. That's the finance cost. Yeah, for the year. How much was the interest? Yeah, because we have to add it back to the balance brought down. So I'll check that interest. Yeah, this is the finance cost. It was how much? It was 450. It was 450. Yeah. So I'll add it back, then I'll sum this two, and I compare with the closing balance. So it's 477. Then what was the carry down balance? I think it was 21. Huh? Let me see. So it's somewhere. Yeah, accrued interest, it was 21. Yeah, so this is how you reason. Huh? We had a balance of 477. We're supposed to pay 477, but we have made payment, and now the carried down balance is 21. So how much did we pay? Is the difference between these two. Yeah, so interest paid. So it's the difference. The payments, I'll start with the smallest, then I subtract the bigger one. Yeah, so the interest which was paid was 456. Yeah, it was 456. Yeah, so let me see. So interest paid, copy that. Then how much was paid? It's 456. Let me select it. Paid an interest of 456. Very well. So we continue. Check whether there's anything to adjust. So we are at accrued interest, current tax already adjusted, obligation under finance lease already adjusted. So those are the only adjustments. Yeah, the adjustments are now over. So we'll cash flow from financing activities. From financing activities. So we'll sum this, all the items under financing. Yeah, so we'll have 31,14. And let me bold this. And this will now be C. Yeah, so that once you're done with this, let me create the top border. Yeah, once you are done with that, so the net cash flow will be, sorry, let me do it here. The net cash flow will be equal to A plus B plus C. Yeah, the operating, investing, and financing. So I'll pick that. I'll pick this. You add to this. You add to this. A plus B plus C. Yeah, then this, you are supposed to add it to cash and cash equivalents brought down. So when you add it to cash and cash equivalents brought down. So the cash and cash equivalents brought down. So we'll check cash and cash equivalents brought down on the statement of financial position. Yeah, so we'll go to the current assets. So that's where we'll get to the cash and cash equivalents. So financial assets at fair value, those are cash equivalents. Yeah, so cash and bank balances, financial assets at fair value, and bank overdraft are the cash and cash equivalents. Yeah, so we'll check the balance brought down. So it was this plus this. Yeah, this question, there was no bank overdraft. Yeah, so we'll add 30 plus 390 and enter. So once we enter, when you add this plus this, it should give you the cash and cash equivalent carried forward, sorry. Cash and cash equivalents carried down. Yeah, so the net cash flow plus cash and cash equivalent brought down should be equal to cash and cash equivalents carried down. So let us see. So I'll sum the cash and cash equivalent brought down. Carried down, yeah, carried down or brought down. Carried down, sorry, not brought down, carried down. So financial assets at fair value, it was this plus this cash bank balance. So it will give me 645. So let me see, let me clear the top border first. So it's 225 plus 420 equal to 645. Yeah, it's equal to 645. So it means that we are correct. We are correct, and that's how you're supposed to do that question. That's how you're supposed to handle that question on group cash flow. Yeah, so I'll attach this question on the description. And if you're watching this video for the first time, we are on our way to 1,000 subscribers. Please subscribe and like my video so that many students can get to know what we have under my YouTube channel. Thank you. Until next time, bye-bye.